Hey, Tracy, welcome to the show. I appreciate you being here.
Thanks for having me. Glad to be here.
Selfishly, I'm excited to be able to ask you a bunch of questions because even as a financial coach, annuities is difficult for me to try to explain. It's not my zone of genius, and there's a lot of jargon, there's a lot of buzzwords and different types of annuities. So I am very excited, oddly, to have a conversation about annuities with you
They're
today.
complicated.
Yes.
Yeah.
Well,
Ready.
I want to start with kind of a big picture question is what do you wish more people knew about annuities?
Man, um, we could be here for a long time. But I think more people should know that they're not all designed for income. And I think that's where a lot of people normally associate annuities is they think of annuity and they think income. And actually a lot of annuities are moving in like the accumulation or we would say like the buffered or safe accumulation direction. I think there's some pretty cool options on that side that more people should just look at. That would definitely be a big one. I'm just going to add in another one is that not all annuities have a whole bunch of fees associated with them either. That's another one. You hear talking heads out there, is what I'll say, or social media personalities, and they might be anti annuity for a few specific reasons, some of them legitimate, some of them not. And they seem to bring up the whole, annuities are evil because they cost a whole bunch. And that's just not true. Yes, there are costly annuities out there, but a cost is only really a problem if there's no benefit on the back end of it. So you can find them with no costs, you can find them with costs, and it depends on am I willing to pay that cost to get the benefit that it's going to give me, and that's really situational.
Okay, digging a little deeper for somebody that's never heard of it or you're not familiar, what is an annuity and what problem does it solve? Like why are annuities a thing?
Awesome question. So an annuity is an insurance product. Some people kind of look at that as like, what do you mean insurance product? It's an insurance. It insures you against certain types of risk. It's just kind of insurance in kind of like finance, and then a lot of them kind of investment, kind of in one. But it's still an insurance product, still regulated by the insurance commissioner's office and Department of Insurance and Financial Services and NAIC. But it's a contract, is what it is. It's a contract, and that contract is essentially unique to whatever benefits that it's going to offer you. And it says, hey, we are going to do this for you. Now, one thing that every single annuity has in common, which is kind of how they started, is that actually every single annuity has the ability to offer you an income that's guaranteed for the rest of your life. It's called annuitization. And every single contract can be annuitized. Not every annuity is meant to be annuitized. That's just how they can stay within like the realm of an annuity, is that they have to have that contract stipulation in there. But some annuities are meant for, hey, this contract is meant to give you an income for the rest of your life. Sometimes they stink. Sometimes they're really really cool. Some annuities say, hey, we're going to give you this fixed return for a period of time, like a CD. A lot of people call them insurance-based CDs, right? So that's not like a pension plan, like an income annuity. So it's a different design. And then now you get into the complicated ones, like an indexed annuity, which is tied to the market, or a variable annuity, which is essentially invested in the market, which have different levels of guarantees in them as well. And those can go down some pretty deep rabbit holes, which I'm more than willing to go down if you'd like.
Yeah. Yes, we're going to definitely dig a little deeper, especially on the different types. I recently did a show on the survivor benefit plan. How, for people that might be something they're familiar with is, if the service member passes away, if you have the survivor benefit plan, you are guaranteed in 55%, if that's what you paid in for,
Right.
of the service member's retirement income monthly. Is that kind of similar?
Yeah, yeah. So um, think of it like we're all pretty familiar with pension plans, right? So you work at wherever you worked. In this case, maybe you're a member of the military, and either a portion of your check or just time in based on your grade, right? You get a pension, right? So a pension, everybody can kind of relate to as understanding that, hey, it's this stream of income that I'm getting that I worked hard for essentially the rest of my life, or, myself and my spouse's life if I elect to pick that option. So that stream of income is essentially the same way an annuity works. In this case, it's just kind of guaranteed by an insurance company, which is why it's important to make sure you're going with a good one. And in this case, you have to buy into it, right? So if you're going to go with like an income annuity, a lifetime income, or a joint option, instead of you buying into it with time or time and grade or time and service, in this case, you're buying into it with, well, I get a chunk of money and I want more pension or a bigger pension, or I want more lifetime income, then you're essentially buying into that. So it's more understandable that way. But again, still nuance and complexities behind it.
Why do people have such strong opinions about annuities? I think there's both confusion and strong opinions.
Yeah.
Why is that?
Probably because most of the negative connotations around them are actually true, unfortunately. I can tell you I see more bad than good out there when it comes to annuities. Not to say that, I think more people should have them. The problem is people have had bad experiences with bad ones, or with a bad agent or an advisor, or they were in the wrong one. It's one of those things where I can't tell you, I've come across, thousands of clients and retirees, and probably thousands that have annuities. And I can probably count on two hands how many of them I were like, oh, yeah, that was appropriate. It's either the wrong annuity, the wrong time frame, the wrong type of annuity, the wrong amount in that annuity. And it's one of those things where if you're Googling or researching annuities, I personally don't mind the fact that when people see stuff, it's mostly negative. It is changing. That shouldn't sway people into not looking for them, because there's negatives in all parts of finance. It just means that you really need to do your due diligence. If I go buy a bad stock and I don't like it, I can just go sell it. If I go buy a bad ETF, if I go buy a bad bond, depending on the bond, you can get out of it pretty easily, right? Hopefully before you lose any money or whatever. In an annuity, it's a commitment, right? So that's the problem, is if you've realized too late, well, now you're stuck in this thing and there's a bunch of penalties, and that's what gets people in trouble, and that's what gives them a bad name.
What type of person or family situation would annuities be appropriate for? And on the other side of that, who is it not appropriate for?
Both great questions. So who they're appropriate for is definitely somebody who's looking to make a little bit more of a conservative move in their portfolio, right? Like, okay, I'm either approaching retirement. I would say if you're about 50 years old and your plan is probably not to retire, or at least use a chunk of funds till about 60, that'd be the furthest I'd go away. But I kind of prefer between the ages of 55 and 75, either pre or post retirement. And they're looking at their assets and they're saying, I have what I have. It's almost like you've kind of won in a sense. And how do I make sure that I don't lose what I have? It's like the whole Warren Buffett, rule number one. What was it? Rule number one is never lose any money, right? Or something. Rule number two.
Yeah.
So you want to, when you're making money, you try not to lose it as best you can. So somebody who's appropriate for them, somebody who's looking to be a little bit more conservative, and or looking for an income stream to fill an income gap. We like to run an analysis on this stuff. So, let's say somebody has $1 million and they have $50,000 a year coming in first between multiple income streams, but they really need about 80. Okay, great. So we know that $30,000 gap is something we want to solve for. What is going to give us $30,000 fairly consistently without a lot of risk? And you could take risk with it, but what if you don't want to? That's going to be where an annuity comes in. We're going to take a chunk of that $1 million. We're going to solve that. Now you have that nice baseline to work from. So that's probably the main people that could use an annuity. The other side are going to be people that maybe their income's already solved, or maybe they're not really worried about it. Like, yeah, I got a $30,000 income gap, but I got $10 million. Okay, that's an easy solve, right? So for that side, now it's not necessarily about solving for income, it's solving for risk adjusted return. So how can we get a better return for you, but on a lower risk level, right? So maybe you don't like the idea of a CD or a treasury or a bond, making 3 to 5%. Maybe you like the idea of having a little bit better return than that, but you're trying not to take the risk on that might some assets in the stock market have. That's where you turn towards maybe like a safer accumulation annuity, which again are niche products.
How does the role of, well, let me back up and ask this question first. In the community, I've heard it, and there are a lot of people that have been encouraged or bought, basically taken the money out of their thrift savings plan and purchased an annuity at, let's say, 40 years old.
Yeah.
What are your thoughts on that? Like, and it could apply to another your 401k, taking the money all out and buying an annuity. What are your thoughts on that?
Yeah, I've seen it too. And I try not to judge situations too much without getting all the details. I'm sure there are situations where that can make sense. I personally am just really not a fan for annuities for people that are younger. Now, again, if somebody is like afraid of their own shadow and they're really conservative and they can't even stand the thought of potentially losing any money, and they just want to be completely out of the stock market at a pretty young age, I would do my best at trying to convince them not to do that. But because they have time and, stock market does great over a long period of time, just not over a short period of time sometimes. But if they were just flat out never going to do that, sure, I could see where maybe potentially adding in an annuity for them would make sense. But in most cases, if somebody like my gut reaction, like, would you do this? It'd be no. And and there's a couple of reasons why. So the main reason is that you have time. When you're 40 and you have a retirement asset, you can't touch that till you're 60 anyways, right? If it's qualified. So if that's the case, you got a 20-year time horizon, right? That's a long time. There has never been a time in the market, and again, you don't have to have all your assets directly invested in the market, but there's never been a time when the stock market didn't 3, 4, 5x over a 20-year period, right? Even when taking times like retiring in 2000. If you retired in 2000, by 2020, you had already 6x'd your money. Even going through 2000, 2001, 2002, 2008, even in 2020, you still 6x'd your money, right? By the time you got to 2026, you 9.5x'd your money, right? If you're in like the S&P 500. So it's not something, understand that time horizon is very important, right? So that's my biggest concern. And the other side is, even if it was like cash, this is common misconception. I'm going to go off on a little tangent here, but I hear people, they put cash into an annuity and they think that it works just like a brokerage account, right? If I go and I put cash into a brokerage account and I buy stock with it, I can sell that, pay taxes, not a big deal, and I can use that, right? That's not the same in an annuity. You can't go buy an annuity with cash, figure, I'm going to stay in it for 5 years and then sell it and use that cash elsewhere. It's a unique IRS rule that if you are not 59 and a half when you decide to do that, okay, and you go and you try to use that money, not only would you pay ordinary income tax on any gains, which there's better tax advantages elsewhere in my opinion, but you're also going to pay the IRS 10% tax penalty on all of the gains. And a lot of people don't know that, and I see a lot of people get mixed up in that too. So those are just a couple moving parts to be aware of.
Yes, that's a really good point. Often people hear things or are told things and don't understand the tax consequences of what they're doing. So that's a very good thing to bring up. Yeah. How does a service member, veteran that has, a military pension, disability, and or the thrift savings plan play into annuities? And, because a lot of times, I guess we should back up. Like, this is a product that's sold to people, right? People receive a commission off of it.
In most cases, yep.
Yes, and so if somebody's trying to sell them an annuity, is this something that a good salesperson is going to bring up? Oh, wait, you do have some guaranteed income.
Yeah, right. Yeah, I always tell people this. Sales seems to get like this bad. It's like the 4-letter word, right? But it's kind of like a lot of salespeople do it to themselves. So it's a reason why you do have to be careful, especially when something like a mutual fund or an annuity, something where somebody's selling it, and they're making a commission. Now, does it make that bad if you're doing it ethically and honestly? No. But again, if somebody is leading with an annuity and they don't know anything about your situation yet, I think that should raise a red flag. And I'll even use my own practice as an example. My practice, we actually lead with annuity marketing, but it's educational marketing. So a little bit different, right? We're trying to get education out there to people. And then what we do is we backtrack, right? So we bring in people that want to learn about annuities. We educate them on annuities. And then when they're like, okay, well, that sounds good. Well, kind of where do we go from here? It's like, okay, well, now we're going to backtrack and figure out if you're even right for one. That's our process. And it seems that is not the case in for a lot of people. They look and they see you as a price tag or a chunk of money laying there, and they look at you as a number, and that's not the right approach, right? It's one of those things where if you don't have a problem that an annuity solves and you go purchase an annuity, you likely just created a problem, because that's kind of how it works, right? So they have to do their due diligence. That's why it's really hard in the annuity space for somebody to have an insurance, like if they're only an insurance agent, it's really hard to take that role on and kind of hop into the shoes of a financial planner. And now let's look at everything so I can narrow down if that's appropriate. And unfortunately, your members are going to get in front of people, and it happens all the time. They're going to get in front of people that don't know what they're doing. They're just trying to sell a product.
What should people understand about fees and surrender charges and the commissions when they're deciding if this is something they want to do?
So let's go through kind of like a definition thing here first, right? So when I've said this before, and I would say without context, it would actually be misleading. So there are actually annuities with no fees. Here's the context. So the context is, it does not mean the insurance company is not making money or I'm not getting paid. It's just in a form that's not a fee. So I like to break it down in a couple ways. So first thing is, what are all the charges or spreads or commissions or whatever that come out of a product? So the first one to be aware of is that most, not all, annuities will have a surrender period. So a surrender period is essentially a length of time before you could potentially get out of it, right? Some annuities are meant for you to be in there for life, like a lifetime income product. Some are not. So it could work like this. You put $100,000 in, and if you try to get out after 1 year, and it's a 5-year contract, you're going to get charged 10% in penalties, okay? And it could even be worse than that. And then year 2, 9, 8, 7, 6, 5, and then 0 for your last contract, right? Or after your last year, 0. So that would be what we call a surrender schedule. So be aware of that. If you need liquidity during that time, that means you got to make sure don't put too much in. And most contracts you can take about 10% out a year without a penalty. So if that's something that's okay, then make sure to find a contract that has that. So that's a surrender penalty. Okay. The next thing is an inherent fee. And just to clarify, there are contracts with no surrender penalties as well. Okay, they're called fee-based annuities, where the advisor charges a fee, you can actually get out anytime. They're rare. So the next one is a fee. So a fee is actually what's deducted from your actual account value. So if I put in $100,000 and I have an advisor fee on there, called a fee-based annuity, or I have a rider fee, meaning I want an extra benefit I want to add on there, then that fee will come out. So this is actually where variable annuities get a bad rep, because they can have some pretty nasty fees in them. So it could come in, again, in those two forms, or it could come in what's called a sub-account expense ratio, which is essentially a fee. And they could be 1%, they could be 0.5%, but most of the time, they're averaging probably more close to 1.5%. If you get into variable annuities, you could get up to 3, 4, 5%, which is kind of nasty.
Yeah.
I say that, but I've seen some variable annuities with 3, 4% in fees that absolutely killed it, So again, it really is, you kind of have to take that stuff with, okay, that sounds like it's terrible, but like, what was the result from that, right? And that's why I always try to judge it that way. So Okay, a little long-winded here, but the next thing would be like a spread or a margin. Okay, so this is a really important one. I think very few people understand, even in the finance world. So this is actually, I refer to this in two ways, but one is how the insurance company actually makes money, right? So the insurance company makes money based on a spread or a profit margin, right? Or an expense margin. So they're going to go and invest your money in places that are fairly safe and it's regulated, and it creates income, and they take a piece of that income. Okay, and then the rest of it is basically designed to invest and then make you more money. So that is not a fee, right? That margin is not a fee that's coming out. It's a margin or a spread. That's not something they're deducting directly from your account, or it's all, your contract. If your contract says you're going to get 5%, you're getting 5%. If they go and they make 8% on your money, right? That wasn't what your contract was. So it's not a fee. And I think that really needs to be understood. So understands that, yes, they're going to make money and they're going to make profit and they're going to make margins, but understand what you're getting for your contract. If you're worried about the rest of that, that's called, opportunity cost loss, and you probably shouldn't have went into an annuity to begin with. And then most of commissions are going to be paid from that profit margin. Most insurance companies work on about a 2% spread, 1% profit margin. So they're essentially paying the commission out of there. And the commission doesn't always come from the carriers or the insurance companies. Sometimes it can come from the client. That I would say these days is a lot more rare. If somebody does say, well, Mrs. Jones, you're not paying my commission, listen, it's misleading without context. You're paying it. How the insurance company is making money on your money, you're paying it. It's just not being directly deducted out of your account. So I think context is there. I always tell my clients, listen, I'm definitely making money and it's coming out of your pocket at some point. But let's talk about what the contract is and what it offers, and you tell me if that's worth it to you.
We've touched on it a little bit. I want you to explain this to me like I'm an eighth grader or possibly a third grader. Is what are in general the different types of annuities, and how are they different?
Okay. So you can actually break down annuities into two main categories, which is immediate or deferred. Okay. An immediate annuity is fairly simple. So an immediate annuity is a contract that says, you give me $1. Let's use more than $1. You give me $10, and I'm going to start giving you $1 each year for the rest of your life. Simple. If you only live 10 years, you got your money back. But if you live 30 years, you 3x'd your money, right? The risk is on the insurance company, not you. If you don't like that deal, don't do it. That's an immediate annuity. A deferred annuity comes in a couple different forms, but going on the same path of income is you give me $10. Now, every year you defer it, I'm going to increase your payment. Okay. And this is why not all annuities are created equal, because some annuities give you really good deferred payments. Some annuities stink. There are some household names out there that know their household names, and they give you worse payments because of it, because they know you're going to buy from them. So be careful. Make sure to do your research. But maybe that one says, okay, well, after 5 years, I'm going to start giving you $2. Oh, okay. So now I'm getting double the payment, but I have to wait 5 years. So now you have to look at like break-even points. In this case, it's still 5 years. But then you kind of look at, okay, well, the longer I live, if I defer it, I actually would make more money long-term. So that's where working with the right planner is important to determine if deferring it or taking it immediate is correct or not. Those are your two main categories. Moving through onto the deferred side, now you move into non-income deferred contracts. So these would now, you've moved from income to essentially growth. So we have one called a fixed annuity, and it's simple. You know what a CD is? You're getting a fixed interest rate for a period of time. If you try to take the money out earlier, you get a penalty or you pay a fee. Same thing with a fixed annuity. It's just now it's through an insurance company and not a bank. A bank has FDIC insurance. The insurance company has the State Guarantee Association, which you always got to do some research on that, but it's legitimate. The next type is a fixed indexed annuity. These are one of the most sold today. I would say they're the most complicated type, because it's almost like it's like you have a chassis if you're a car person. You got your wheels, you got your frame, and that's kind of where it stops. And that's called a fixed index annuity. But you can add a completely different motor on it. You can turn it into a car or a truck or an SUV. So it's very customizable. Some products are designed for income, actually. Some products are designed for growth. Some of them are designed for long-term care. So that's where it gets complicated. So that's the next one. That one, all of them follow the same guideline, which is essentially how you make money in that is based off of an index. So you put the money in, index uses the S&P 500, the S&P 500 goes up, you will make a return based off of that. As long as your fees don't eat it alive, and you're not getting all of it. You're only getting a portion of it. Okay? Think of it this way. If the insurance company is able to give you all of the S&P 500 and then protect you on the downside, it'd be like the perfect investment, right? So in this case, they're going to cap you in some way, shape, or form, right? Sometimes the cap can be really good, like 12+%. It's like, oh man, I can make up to 12%. That sounds great. Sometimes they're really bad, like 2%. So it's like, oh, essentially I'm making nothing. Yeah, right. So that's a fixed index annuity. Its kind of sister is called a registered index linked annuity, and very similar design. But now what they're able to do is say, listen, let's lower your floor. So instead of giving you this, you can never lose money, what if you could lose 10% or 15% or 20%? And then we'll kind of cap you on the losses, or we'll even eat a certain amount of those losses. So that's called a buffer. But because of that, since you lowered your floor, we're able to increase your ceiling, right? Because you're taking on more risk, therefore you can have more reward. And so that's called a buffered product. And so instead of like a 12% cap or a 10% cap, maybe you can get a 15 or a 20, or in some cases no cap. Or I know this is going to sound wild, but sometimes you can actually buy up an index like the S&P for more than 100% of it. So I remember seeing a couple contracts back in 2023 where they had 140% of the S&P. S&P goes up 10, you make 14. Through options trading, I'm not going to get into it because a third grader or an eighth grader would never understand that. And then finally, a variable annuity. And so a variable annuity, that is the only type of annuity that actually is directly invested in the market. It's called a sub-account, a lot like a mutual fund. So you get all of the risk and all the reward of those funds. They charge quite a bit of fees normally inside of them, but then a lot of them will have riders like income riders and stuff like that. I would say sounds like those are starting to kind of, I wouldn't say be phased out totally, but a lot less popular than they used to be. So, and there's always all these little kind of like QLACs and these little different types of annuities out there. But those are your main ones.
It sounds very complicated. I mean, you made it sound very simple, but there are a lot of moving parts. And, to one of my earlier questions, like who is this best for? Would you say for most people, like especially to people that listen to the MILMO show, the majority, this might not be it, especially, if they have already guaranteed income through a pension and disability, and potentially also have the survivor benefit plan for a military spouse. Like, for most people, would purchasing an annuity make sense?
Yeah. So normally if you're going to have a bunch of different streams of income, I would say statistically speaking, that type of annuity, like an income annuity, will likely not make sense. But I kind of unpack that more and I say, well, you have all these streams of income, but do you still have an income gap? Because sometimes people still have lots of streams of income, but it's still way less than when they were working. So if the gap is still there, we don't mind adding in that income. I would still suggest exploring it. And then ultimately, this is going to summarize finance in a way that almost is too simple, but I always like to use it because it makes a lot of sense. So there's only two things your money can do. Just two, okay? You can either spend it or you can give it away. That's it. If you think about your money and what it's, let's say I have $1 million, from now to the day you die, what are you going to do with the million? Well, I'm going to go on vacation. Okay, you're spending it. Well, I'm going to invest it for what end? Because if you just invest it and you never do anything with it, guess what? You die and somebody else gets it. That's giving. I'm going to give it to my church. Okay, that's giving. I'm going to gamble it. You're giving it to the casino. I'm going to give it to my kids. That's still giving, right? So it's always spending or giving. And I ask that question to a lot of my clients is what means more to you, spending it or giving it? And I would say most is a blend. But you'll find that if you start to separate that, like, oh, I think I want to be able to leave, I have $1 million. I want to be able to leave 300,000 to my children, right? Or I want to allocate that. Well, now what we've just done is we've just essentially, we've allocated our money to complete a task. I now have 700,000 that is for spending. I now have 300,000 that is for giving. If I don't end up spending all of this, it'll be given, obviously. So that's what the approach I like to take, because ultimately that will allow me to design a portfolio, design a retirement plan that meets that person's goals, which is either spending it or giving it. So like giving it would be, a long-term buy and hold, maybe your Roth accounts or your brokerage accounts, get step-ups on the cost basis, all that cool, fun stuff that you can do. Whereas spending it, I like to spend down qualified money, spend through an asset. Again, an income annuity could be great for that because now you can spend and that just refills every single month. It could be a dividend portfolio, right? It could be whatever. It could be a bond ladder. So to go back to your question, I think if somebody is to explore an annuity, I think it's more about what their spending habits are and how much they want to spend, or how much risk they're really, truly not wanting to take on. That's going to tell you a lot more.
If somebody is interested in an annuity, how do they find the right person to help them with that?
If there was a magic way to go about that, I probably wouldn't have a job, because a lot of my job is teaching advisors and agents how to do this stuff. So I think that is a question that is almost really hard to answer. So you would think this would be the process, and I'm gonna kind of tell you what you should do, but also be careful. So the first thing is go and find a fiduciary, right? So when we say a fiduciary would be somebody who, they're going to be like a fee-based advisor. They can still sell annuities and be a fiduciary, but let's just say you go to the opposite end of fiduciary, which is essentially like a fee only. I charge a planning fee only. Okay. So if you think about that, if somebody charges a planning fee only, they have no bias in what you buy. They have no bias in what you invest in. So you would think inherently you're going to find people that are going to have your best interest and that they'll be able to guide you, which you'd be right. But then the problem lies is, are they an expert in everything? And the answer is no, right? So what we find is, even if you go that route, you'll probably be more likely to find somebody who will be a little bit less biased, but not as much of an expert in things like annuities. So I think it's just the old-fashioned elbow grease, interview advisors, and get a good feeling for if that person is trying to push you in a direction you don't want to go, right? And just kind of, it's not a bad idea to pit them against each other a little bit, right? Make them earn your business, I don't mind that. I don't mind a little competition. So yeah, there's just not a lot of great resources out there, but I think it's getting better. But I would say you're least likely to probably find somebody who's insurance only licensed that will do what's best for you. I'm saying that, and I got a lot of friends in that industry, but it's just statistically the probability is less.
What are some red flags that people should look out for then?
So obviously leading with a product before you even understanding your situation, right? Like, look at this great bonus product, or this, it's like a specific product. They're not just educating on annuities, they're talking about specific products. That is a big red flag. How am I supposed to, it's like, I don't even know what car you drive, and I'm already trying to sell you a set of tires and rims that I don't even know will fit your car, right? So
that is a great analogy. That is a really good analogy. That is so true, because it's right. Like, they don't have a full picture of your financial situation. How can they already know exactly what is perfect for you?
Yep.
So that is a good analogy. I love that.
Yeah, that's a big one, and it's we see in the industry all the time, unfortunately. Yeah, that's a big one. Honestly, and I'm saying this, but if anybody talks to you about a bonus or a bonus strategy, what's the other big ones? Roth conversion strategies, just run away. They're just all gimmicks. There, I can, again, out of the thousands of people I've come across, I can count on probably one hand, maybe two, how many a bonus was right for. It's just it's very much a marketing ploy to get you in, and you're just gonna regret it. So yeah, stay away from those. I think if you just understood those two things, I think you'd probably flush out most of the crap that's out there.
That actually kind of what you said there leads to my next question is what it seems like a different language. And I have, even as a financial professional, I've heard, presentations or seen things online about annuities. And I'm like, I know this is wrong, but like their words they're using, it's like a whole nother language. So what are some key phrases or words that people, in addition to one you just mentioned, should watch out for and should be like, you know what, like I see you're not being honest here.
Yeah. All the upside without the downside, you get market gains without the risk, without telling you like, oh, but they're capped. I think a lot of agents and advisors that do it the wrong way, I think they lead with performance. And ultimately, like those are such a niche product to begin with. Most performance annuities stink and don't perform. I think when they talk about tax benefits, there's only one annuity that even has a tax benefit, and I personally don't like it. It's called a QLAC. Annuities are not inherently tax beneficial. I would say in most cases, they hurt people on the tax side more than they help. Now, I say that, but there's some really cool tax plays you can do with qualified money. But yeah, there's no inherent awesome tax benefit that you can't find elsewhere. Annuities are not unique in any way, shape, or form from a tax perspective. Again, other than actually two areas, which are, again, rare for anybody to lead with that. Most people will lead with these tax benefits, which is essentially tax deferred, which you can literally find everywhere else. So, yeah, stay away from that. So bonuses, tax benefits, those are some good ones. Those are some good ones to start with.
If you had, if I was your sibling or your cousin and I came to you and I said, hey, I am 40 years old or my age, and I just met somebody and they were telling me I should take all the money I've saved up in my thrift savings plan now that I'm separated or retired, and I should purchase an annuity with them, what would be your reaction, your questions, or what would you say to your family?
My initial reaction would be there's absolutely no way that is a financial planner of any kind, right? Sounds like an insurance agent trying to sell a product is what that sounds like. Because anytime you hear all in one thing, that's bad. Like, what benefit does that person have in doing that? Well, it's probably because they don't have other options, right? Which means they're probably not securities licensed. So that's normally my one big thing. But also, going back to that though, you should never have all of your money in any one thing, in my opinion. I do think that diversification you can be over diversified and that be a bad thing. But yeah, you can't just throwing this out there. You actually can't put all your money into an annuity. I've actually seen it, and it can only be done using multiple annuities and lying in an application saying, no, we're just applying for one. And yeah, be careful with that one. Seen that one a lot. Most of the time, if you surpass 50% of your total assets in an annuity, that starts to be a yellow flag. I would say in my case, like my clients, most are between like 20 and 30% of their total net worth. I do have clients in 50% and above, but it's so rare, very unique situations. The questions I would ask, I would definitely want to see like what licenses you have, right? And again, not harping too much on my insurance folks out there, because I know there are some that do a really good job, but inherently, I would want to see like, what are you qualified to actually give advice on, right? If it's insurance only, that's fine. You can be an insurance expert, you can be an annuity expert, but you better not be giving, buy, sell advice, right? So I want to see your licenses. How long have you been in the business for, right? I actually don't trust people when they say that, so I just look them up. Every state has a database. You can go and look people up. So you can go see how long they've been in. I think there's a sweet spot. The sweet spot that I've seen is, and I'm not trying to be negative towards some advisors that have been doing this for a long time, but it's weird. I come across these advisors that have been doing this for 20 plus years, and it's like some of them are worse than the 1 or 2 or 3 year folks, just because I think some people get lazy. So I find there's a sweet spot, not too young, too old, whatever. It's like 8 to 15 years, like maybe 6 to 15 years, somewhere in that mark. Like 6 years doing something, you could be really good at it. And so I like that time frame. Granted, I got a couple guys that work with us that are, they're old dogs and they do a great job. But it's just, again, I'm kind of using like generals, right? So how long have you been in for? And then just ask them how they get paid, right? They should be transparent. Like if somebody asks me how I get paid, like, oh yeah, I make a commission. Let me explain how that works, right? I'm not trying to hide it. Why would you try to hide it? If you try to hide it, that means you have something to hide. No, we it's okay to talk about how you get paid. It's in the absence of value it matters, but when there's value there, in transparency, it doesn't matter that much. So I'd start with those ones.
I want to know if you could explain more something you said in there is buy sell advice.
Yeah.
For people that aren't familiar, what are you talking about?
Sure. So if somebody says you should buy this stock, you should buy this security, essentially stock, bond, mutual fund, ETF, those are securities. So you have to have a securities license. Now, I can educate you on them if I'm not a securities licensed individual, but I cannot give you buy-sell advice. And then the sell side is you should sell those securities to, I don't know, buy this annuity, right? So we see that all the time. It's like, well, I had this $1 million in my brokerage account. This advisor told me to sell all my bonds and put it into an annuity. And then you look it up, and the advisor is an insurance-only licensed person. It's like, they could I don't know if they go to jail for that, but they can definitely get their insurance license taken away for that. That's direct sell advice. We see the sell side quite often, right? Because annuities are essentially, they compete with bonds, right? So that's kind of like a bond alternative. So, people know that and you got bonds in your portfolio. You better go sell those and buy this annuity. Be careful for that one. Again, if you're securities licensed, so if you're, so securities meaning, Series 6, Series 7, Series 66, Series 65, Series 67. You'll be able to find them on BrokerCheck or so brokercheck.org, or you can go to the SEC's website and you can research them on there. So if they have a profile on there, they're securities licensed. If they don't, then you go to your Department of Insurance and Financial Services website and you can search for them on there. And if they're on there, then they're insurance only. Again, nothing wrong with that as long as you stay in your lane and they know what they're doing.
Right. I think education is the key here. Like if you don't understand it, you should be asking more questions before you put money behind it.
Absolutely.
I think so many times, and just like this, I mean, I will freely admit as a financial coach that has a financial planning background that it's still hard for me sometimes to understand some of it because I don't do it. It's not my expertise.
Right.
And so being willing to admit, like, yeah, I don't understand, I think is a skill that just in a lot of things in life that people need to admit more because you're actually going to hurt yourself financially if you don't talk about it. I always give the example. I read an article one time about Mary J. Blige, the R&B singer, and she talked about how she got in so much financial trouble because she was in so many meetings with all these attorneys and financial people, and they were saying things that she didn't understand it, but she would just sign. And then it ended up she got in so much trouble instead of just being like, hold up, I need you to explain that. That's why I say I need you to explain it to me like an 8th grader. Or I always say, dumb it down for me. Dumb it down. Like, I don't get it.
Yeah, that's super smart.
Well, I know that there's a million more things I could ask you about this. I'll definitely have to have you back on this show, Tracy. And then anybody listening, definitely send in any questions you have. So that way I'll be able to ask Tracy in the future. But I want to switch gears now and ask you a couple of quick random questions I ask everybody.
Sure.
First off, what is one resource or tool that you use that makes your life or your work easier? And you can't say AI. I've had to rule out that answer.
Man. I want to say so many things. Resource or tool that makes my life easier. Okay, I'm gonna go with. This is gonna sound. Is it so? I have a lot of finance stuff, right? So like finance tools, which aren't really like. I wouldn't say they're necessarily for the people that are going to be watching this. So it's like.
Yeah, no, you can listen. You can say them.
Okay.
There's a lot of financial advisors that listen to the MILMO
okay,
show.
Awesome. Okay, so I like doing so there's a guy out there named Bobby Samuelson, and I like his he has like a blog post and stuff, and it's called the Annuity Review, and I think he puts out some really good information on there. So I think if you're a reader, you like to read up on that stuff, I think that's a good one. And then pretty much anything from Michael Kitces would be another one. I'm a big Kitces fan. So those would be my two resources, like one annuity specific and one just pretty much like everything finance ever, right? So, yeah.
Yeah. Okay, those are great. I'll put links for everybody in the show notes. All right, what is your favorite book right now or your favorite book of all time?
My favorite book right now that I'm in is probably The Art of Spending Money by Morgan Housel. Or there's another one called Do It Afraid by Kent, and I don't even know how to pronounce his last name, Chavalier or something. He is the chaplain for the NFL. It's a really cool book. It's called Do It Afraid. Yeah.
Ooh, I love that.
Yeah.
That's my big thing. Have you ever read Take the Stairs by man, it just went out of my Rory Vaden, and there's a story in there. He talks about doing things scared, and that's like one of my biggest things, because it was like a woman that she was in a burning building and she wouldn't leave because she was scared of stairwells.
Oh, wow.
And so the firemen are basically like, you just are going to have to do this scared. Like, we're still doing it, but like, you're just going to be scared. And so anyway, that appeals to me. So I'm going to check out that book. I'll put a link in the show notes for everybody.
Yeah, that's a good one.
Those are good ones. Okay, now it's time for my favorite part of the podcast, which is game time. And in honor of your visit today, we are going to be playing Where in the World. So I am going to give you 3 clues to a famous U.S. city. And if you guess it correctly after the 3rd clue, or if you have it for sure beforehand, you get bragging rights that you won game time on the MILMO show.
All right. I'm competitive,
so
here we go.
Yeah, first clue. This city is known for cheesesteaks, passionate sports fans, and the nickname the City of Brotherly Love. That's the first clue. Second clue. The Declaration of Independence and the U.S. Constitution were both debated and signed here. The third clue is it's the city that is the home of the Liberty Bell, one of the most famous symbols of American independence. So where in the world is this?
I believe
what city?
It's Philadelphia.
That is correct.
Yes.
You get bragging rights that you won game time on the MILMO show. It's a really big deal, Tracy. It's a really big deal.
Well, it's a big deal for me because I told you before this, I am not good at geography. So I'm so glad that was a little easier.
Yes. I did try to make it a little bit more player friendly. So, well, I really appreciate you playing the game and being on the show. Can you tell everybody listening where they can learn more about you and the work you're doing?
Yeah. Well, if you like just kind of general content, I would just say, check me out on LinkedIn. LinkedIn, and I got contact information and stuff on there, but LinkedIn is my main platform. I try to put out good content in there. Some of it definitely goes against the grain, but I think it's refreshing in a lot of different ways. So LinkedIn would be the one to follow me on.
Okay, wonderful. Well, I'll put links to that in the show notes for everybody. Thank you again, Tracy. I really appreciate it.
Thank you for having me.